Francesco Ambrogetti. He just took his last name he off so to confuse us because he's just like that. He's so smart all over. Francesco, joining us from UNICEF today. We're super glad to have you. Oh, and and you have, so the reason we got together and we've been talking is that you've been on a side of the nonprofit world that's pretty new, kind of for everybody, right? It's new for people in finance and it's new for people in philanthropy, and you're exploring this, very interesting but emerging area around innovation. Would you be able to kindly explain a little bit about what you do and what your day-to-day looks like?
Yeah, thanks. Great pleasure to talk to you, being here, of course. Yeah, my title is Director of Innovative and Alternative Finance for Children. So the acronym is IF4C. But the reality is substantially try to find modalities to either accelerate, scale up, or do things differently than your normal grant allows you to do. In other words, if you have a grant and spending through activities, projects, that's good. That's what we do. We
Okay.
can try and find it. But if this is a limitation because it takes too long to raise the money and spend it, it's limited in scale, so you need much more money and you need it now. Or you do two things to make somebody else to pay on your behalf or take your risk on your behalf. That's where the so-called market um, come into play. I think that for the non-profit, for many years the social responsibility, corporate social responsibility, or social investing, impact investing. This is something that resonates in our role more as a, I would just say, corporate partnership or course-related marketing, right? In which the idea is that okay, I partner with a so-called good investment, green investment, or ESG investing, and I try to get a percentage of some of the fees. That's more traditional where we go. But the reality is that I think if you look the size of philanthropy, which is some tens of billions, and the size of all the even the so-called ODA, official development assistance, that is how much many all the governments together put for the so-called SDG, etc. These are so tiny that basically they are they are not enough to do what we need to do. So, point in case, and this is not me, the famous Dan Pallotta and others clearly say our sector is starving of capital. We are starved of capital. That's a fact. I mean, I'll be curious if there's anybody in the audience that can share their experience to submit the budget to either your board or your director. It's a painful experience, right? You submit the budget and you're gonna get nothing of it, or 10% of it. Or the classic conversation is, oh, we need to grow 20%, 20%, 30% this year, right?
Yes.
Like this. And you just say, okay, so if you want to go 30%, I need to
Invest.
do X, Y, Z. We need to just, I don't know, do more campaign, invest more in retention. It means more, I don't know, marketing, and this, and then normally just say, no, you have to just grow 30% using the same budget of last year, right?
Yeah.
More or less. And so this is why it's an unfair game. Dan Pallotta say, all the money goes to the Twitter of this world, to the Amazon of this world, and we are living in this world in which you spend what you raise, which is crazy. It's just like I said to people, the favorite or the infamous subject of this day, Elon of this day. Elon bought Twitter. He didn't spend his money. He leveraged. He got from the market. He just used the market to pay for Twitter. It's that simple. You have, and suppose people have mortgage. Otherwise, you don't have. I don't have the money to buy a place Um,
Well,
we
especially in New York City, correct?
yeah, especially in New York City. We have a lease on a car because we don't have. So that's normal in our life. People in our boards know this very well, and they use that for their own activities. But when it comes to us, is
Hmm.
money in, money out. So I raise 10, maybe I give you some part of this to raise more money. And that's what we say to donors, right? The family is over.
Yeah,
But
of course.
you're never going to grow. You just imagine Amazon or Facebook. They would never been able to are what they are. It just took them 10 years, and every year they have invested massively in acquiring new customers, more publicity, more branding, expanding the operation. If you only can spend the money you raise, well, that's where you are, and that's where the sector is. And so that's the issue where we are today. And so
Hmm.
I think innovative finance, where I'm sitting, or financial, are first of all not new because these instruments have been there forever. So
Hmm.
as I said, a bond, a debt, or a pre-financing has been there forever. It's new for us.
Hmm.
These things are not changing or substituting the fundraising. Fundraising, our bread and butter, is the income we generate. Okay, so
Hmm.
that's to be sure. We are not talking fancy cyber currency or derivatives in products.
Hmm.
We're talking um, private capital that come to non-profit to go faster, go larger, and take risks that we don't do. So that's in a nutshell what it is. So I'll
Okay.
give you a few. Yeah, sorry, go on.
No, 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 no. I'm just so excited, Francesco. So, have you found that people in finance are excited about this? I mean, just kind of the
Well,
interest. Is this
yes,
opening up new markets?
yes, well, more than people in finance is the investors that are excited. That's what the nonprofit misses big.
Yeah.
So your donors, your major donors, your high net worth individuals, their family offices, the foundation, they come to realization and just say, I can give you grants, but this is my assets here. So I can invest in stock, shares, bonds, or I can invest in you or with you to support your mission. That's what they. But if you say no, 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 I just want a grant, you got a
It
grant.
limits so much. Oh, so this
So
taps into another
to-
bucket.
totally talk to your donors and say, of course we need more grants. Of course you need to increase your donations. But what about if you invest part of your money in this thing that also helped me, and then you get your money back? So think about
Okay.
that. I mean, yeah. So this is changing the perception more from the investor perspective. And
Hmm.
financial people, of course, they go with the market. So if they see this as an opportunity, they jump on it. But um, they are not the one that pushing for that. And what they do, I think it's a mistake because they don't know. That's not their work. Um, but that's where we are. So to give you a few examples, so to put things in context, I think we talked last year or this year, I don't remember, about this bond, that we launched with the World Bank. Yeah, this is for me it's the new way to do fundraising. So
Hmm.
your fundraising operation is a profitable, right? If it's a run well, it's
Hmm.
something that over 3 years, 5 years generate return,
Hmm.
right? Because you do regular giving, you do retention, you do legacies, kind of giving, whatever it is.
Yeah.
If that's what it is, you need a budget, right? Every year, and the budget you have, you invest, and if it's run well, it's not break even. You make money out of it, right? That's how it is: 2 to 1, 3 to 1, and so on and so forth.
Hmm.
So instead of going back and begging every year to report to your director, I need more money, you just say, okay, this is my look at my 5 years, 10 years program, right? I'll show you.
Hmm.
Year after year, I just grow, right?
Hmm.
Because that's how it works. Because I acquire donors, I retain them, and I cultivate them, and then I get legacy. So you show that. So
Exactly. It's predictable. It's gonna happen.
perfect. Perfect. So you go to the market, just say, this is it. It's a great investment. It's very solid. Very solid. It's not. I'm not going to just invest money in your crazy. I don't know, fancy gala of raising cryptocurrency. No, I invest in acquiring new donor, regular donor. I do legacies, that's what I do.
Okay.
So at that point, the market say, "What? Why not? Why not? I'll here as my 50 million. Give me back in 5 years,
Okay.
right? Give me back in 5 years. So you get 5 years to use the things. And if you're not able to break even and make money in 5 years, there's something wrong with your program, of course.
Okay. What's
So
in it
for
for
you,
what's in it for the investors?
well, for the investors, that they protect their capital. That's
Okay.
simple. So these are no grant money, but the money they get back. They got the best impact because, of course, this money gonna be 3, 4, 5 times more money and therefore more impact.
Exactly.
And so, what not to like? What not to. So for the investors is they want to see more of this, because especially in
Awesome.
this market, that's the way to do it. So the only thing that's important that this is not a pure transaction; it's a partnership because the way at least I see this is has to be a no recourse type of instrument. That means you investors protect your capital. You're gonna get back in 5 years, but you take the risk that I only return the money if I raise it, and you
Mm-hmm.
accept that. You accept that. So if I don't raise that money, you're not gonna get the money back. If I raise the money, of course, I have an obligation, and it's financial obligation to pay in 5 years. But
Mm-hmm.
this is the type of risk that also the investor. So that's why it has to be a partnership and not a pure financial product, right? So
Mm-hmm.
when you're selling on the market, you just say, this is helping my organization to grow. And if I grow, I can save more animals, I can distribute more food, etc.
Exactly. And
But
historically, every dollar I've invested has resulted in 7x and 4x or
right,
whatever.
but be aware, be conscious that you is a no recourse. So if I don't raise the money, you're losing. And
Mm-hmm.
it's transparent. There's no, it's part of the thing. You help me and you're taking the risk as investor. When I
Mm-hmm.
raise it, I just say, okay, I raise it, then I'll pay you back in 5 years. You still have 5 years to return.
Yeah.
So that for me is one way to look at how the market can support that. There are other ways, of course, that the market can and investors can also support and take part of the risk, no? And one other thing that I think is evolving is the so-called outcome funding or outcome financing. Substantially,
Uh-huh.
um, the original idea, which I'm not very much keen, substantially, that the investors pay on the outcome. So just say, okay,
Mm-hmm.
I'll sort of release my donations if you achieve X, Y, and Z.
X. Yeah.
That's
There was a
one
lot of
way.
noise. There was a lot of chatter like years ago, right? I remember, like, I don't know, 4 or 5 years
Yeah,
ago.
and I think these things is a bit not good for the non-profit because it puts you in a lot of strain to achieve the results, and then who is verifying is becoming a bit um,
Mm-hmm.
the Red Cross did this initially. So they had the Lombard idea that issued this it's called humanitarian bond and based it on the number of basically protheses that they will provide to disabled people will um, they will
Mm-hmm.
unlock this money. But I think this is a bit of a strain on non-profit. My opinion, the right way to do is that okay, I have a big goal to raise. Is a source for
Mm-hmm.
me is that evolution of the capital campaign, right? So
Mm-hmm.
in our case, like we need to eliminate polio. Polio is endemic in 2 countries all in the world, which is Pakistan and Afghanistan. Difficult countries. But if we do that, polio will be eradicated forever, which is amazing, right?
Mm-hmm.
The cost of this is $5 billion though, and I need it now to do it next year. So I need a large sum of money for a large goal.
Mm-hmm.
So in this case, some institutions or some banks will front load the money. Then you're gonna get one, let's say, investors that takes the upside. So let's say, okay, if you reach and eliminate the goal, I reimburse the institution that front load the money. And then you
Mm-hmm.
get another one that takes the downside. Let's say, if you don't, I will reimburse the the financial institution. So you get two investors that protect you from the risk. In other words, you just get the money. And of course,
Mm-hmm.
you have to point to reach the objective that you set, but it has to be large, right? And then
Mm-hmm.
you get some investors that take the risk either to reimburse based on good results or
Mm-hmm.
bad results. But
Okay.
the payment is not conditioned to, you know what I'm saying? The
Mm-hmm.
nonprofit will still have the capital up front, um,
Yeah.
and the risk is taken by others. What is the advantage for the others? Again, contributed to a larger goal like this or whatever it is their goal. Um, and therefore, that for me is the
Yeah.
right way to look at it.
I mean, and this could unlock so many other like externalities, like having skin in the game. I could see some of these investors doing, things beyond just putting the money into
Oh,
their bed,
absolutely.
right?
Absolutely. And that's also even before when I say it's a partnership, it's not transactional because then this is a dialogue you have with your investor is a
Exactly.
partner and just say, okay, I help you to achieve the goal, go faster, or raising more money. I know the risk, and I take part of this risk. And of course, once you're in the game, this is becoming naturally also making more donation, etc., etc. But
Exactly.
this is I think is an important way to look at it. And that a third thing that I like to this becoming more and more, particularly linked to the climate change and natural disaster, is the
Mm-hmm.
insurance linked security or and this is an interesting element because substantially you can say these type of events are less not predictable in a sense you cannot say exactly when they happen, but floods or typhoons are
Mm-hmm.
happen very frequently.
But it's very
So
clear when there is a flood and when there isn't a flood. No, that's the benefit they have.
exact
There's no-
or a typhoon. So the what we did is this first of its kind. It's called today and tomorrow. Substantially, the insurance will be unlocked. So the payout will be done when there is a wind speed that is automatically detected by satellite and the number of children in that specific locality. So the difference is that in that country, so the Bangladesh or the
Mhm.
Solomon Island or the Madagascar, when the next typhoon happen and we will happen, the money will be immediately released. So instead of having to raise it, that takes a long time, you get money right away to respond
Mhm.
to the disaster. So it's a big change. Of course, what is the trade-off? That you have to pay a premium. So in this case, it's $15 million to unlock potentially up to 100 million,
Mhm.
and to get the money right away. So normal questions and normal resistance say, "Oh my God, we're gonna just spend 15 million to potentially having nothing if the event not no." But
Mhm.
that's not the way to look at it because it's exactly an insurance. Yeah, of course, can happen, but we know that these events will happen. There will be a cyclone, typhoons in this country, guaranteed in the next few years. Um, and the difference is that you will have the money right away instead of taking the time to raise it and things. So we'll make all the difference in saving life, you know.
Yeah.
And
It's not
that's
a
a,
question of whether; it's a question of when.
yeah. But again, you can see this as this is another way to look at the innovative model to unlock private money and just again it's a question of risk, who's taking the risk and what is the payout. But I
Mhm.
mean I think by any standard, natural disaster require immediate money, and this will make all the
Well,
difference.
yes, of course.
Yeah.
So let me recap to the best of my understanding of what we've gone over, and then maybe we can do a little bit of a game. Maybe try to come up with like a real life case. So first, I have to say how privileged I am, and we all are, to be able to tap into the office of a technical expert in an area that has such a huge potential. And I am assuming you're in your office right now, Francesco,
I
but
am.
Francesco's with UNICEF, and he is moving this area of innovative financing forward there. So we talked about three ways that are kind of ways to set up aligned interests so that people can dedicate money, invest money in things that are social impact activities, but that also maybe tap into not only their philanthropic budget, but their investment budget. And especially in the case of our wealthiest donors, they probably have a family office, and they're deploying huge multiples of what they're giving away philanthropically in places, right? So one of the ways that Francesco has also pioneered is financing against the income that you're going to have that's more or less pretty certain in recurring revenue streams or planned giving, things that we just know there's a discount rate, and that's pretty predictable once you have that machinery going, right? We talked about financing against huge outcomes, positive social outcomes, eliminating polio, things like that, but setting it up in a way that you have people betting on the upside and the downside, so that the nonprofit, I guess, is like risk neutral, in a way. I don't know if it's the exact term, right?
Yeah. Yeah.
And then the third one is having nonprofits take out insurance, so that does have a cost, but against possible disastrous climate change, the possibly disastrous effects of climate change. And the huge benefit this has is that when this happens, so Francesco was sharing that it's not a matter of whether it's going to happen. There is going to be a typhoon in these parts of the world. The capital is available immediately. You don't have to then start deploying it. Think of all those crises with the Red Cross, trying to do the work in Haiti, raise the funds, and think of the improvements there. So more or less accurate?
No, very accurate. So yeah, these are just an example of how the market can work. Of course, there is all a world of what is called impact investing or blended financing, which then the nonprofit can participate either with his own capital or providing investable cases. So in this case, are either company or projects that needs capital with a registered financial investor and advisor. All this, Luis, I mean, it's good to say that we must say it's an area that is very much regulated. So before even considering to any of these instruments, I think you really need to talk to a registered, accredited financial advisor, and this is not something that you can improvise. So this is an important caveat because it's very highly regulated. But this is another fourth area, if you want, that is very much in need, because what happened today is that the large investments, they are, as we said, the part today is that so much money available that needs to go somewhere. So either they go in the oil industry, carbon emission, or pharmaceutical. These are very lucrative.
Or, I mean, sorry to say it, the next dumb app. Exactly, right?
Oh yeah, exactly. Or they can go to advance your mission. So some companies in that is aligned with you, and therefore you direct capital. There has to be produced return for investors. So this we're talking more on the profit side, but they advance your mission. So we can just say, imagine like a tampon producer for women in Africa. Now you're talking about sexual reproductive health. That could be something that it could be lucrative, needs capital, but will advance your mission, right? Or anything else that you can talk about it. And here is also potentially talk to your reserves, because this is something that we don't talk in the sector, right? So I will ask to any of our organization where your reserves are invested. Talk to your finance director and find out, because that for me is that the game in town and nobody talk about it.
Oh, like the endowment. You're talking endowment reserve. Okay.
Yeah.
Anything.
So you can just see that you will find out that they are invested maybe in fossil fuels, in bad. So why your no capital and your reserves or your endowment is aligned to your own mission.
Oh, okay. Okay. Sorry, Francesco. I have a call here. Yeah, just a sec. Okay. This is Mario Gomez. He's the CFO in a college in the Midwest United States, and he's super interested in what you're sharing today. And by the way, thanks, Beth, for the positive encouragement. Um, so how can we help Mario? So imagine there are people who might consider this on the nonprofit side. I
Mhm.
think you've kind of proven that on the investor side, this is possible. There will be interest. Um, what's a good next step? I mean, how do you even start? Do you give Francesco a call? Do you connect with him on LinkedIn? Are there markets for this?
No, definitely there's market. It depends by the appetite and the need, more important, the need of the nonprofit. Because this is not something that I would go for because it's cool, it's fancy. No, you have to respond to a need. So you have a shortfall because you want to grow your fundraising and you need the money now that you don't have in your budget. Yeah, this is something you can talk to somebody. Just say, can we have? I need 10 times more. Can somebody give and I pay back in 5 years? What are the conditions? So that, for instance, is a real need. I have a
Mm-hmm.
programmatic need. Like I said, I need to really um, scale up. I need to just open, 5 um, food facilities for homeless, and
Yeah.
I don't have. I just need that. Just I pay back. This is my revenue stream. Can I just do something like that? Can I just exactly? Can I just then instead look into something that is more like an outcome funding, which we just say, they apply to the rhino population, white rhino in South Africa. Just say, okay, we need to invest really more rangers in more protected area and then based on the number of rhino that they're very
Mm-hmm.
they produce very very little one, then you're gonna be rewarded if that happens as an investor. So
Mm-hmm.
I get the money now. So it really depends. I would just say really depends by the need of the organization. Is this a programmatic need, an aspirational goal, or an internal need? Right? I need to just um, grow. I just need to just grow.
Mm-hmm.
Or I need to just even be more efficient. Substantially, what we're doing here is to make somebody else pay your expenses. That's what we're talking here, right? Because instead of taking from the budget, you use
Mm-hmm.
your budget for your programs that you should do, and let somebody else paying for it. That's more efficient, right? And then you can say, yes, my 100% of your donation go to
Oh no,
because
let's not go there.
no, but because you set up a
I'm
mechanism
with
that is
you. I'm with you. It's all
market
yeah.
driven. Yeah, because you have a mechanism market driven in which they pay for that, and you have an obligation to pay back. So that's a different
Mm-hmm.
story. But that's the
That
way to look at it. So a financial director should see what are my needs, how can I use this, where I have reserves that I invested in bad things that I can instead align to that, or endowment
mhm.
that can align to, etc. etc. This is the way to look at it.
This is fantastic. I hope we inspire more financial directors. I'm not so sure that the development director is going to be thinking of things in these terms, but I'm hereby sharing my deep commitment, Francesco, to share all your work because I think we truly do need this. And we're going to keep beating this drum until we start to see some movement. What is the best way for people who are interested to connect with you?
I am on LinkedIn, and Instagram, and Twitter. So even on my professional thing, of course, I have a full time job, so I cannot guarantee full support, but definitely I can answer questions. I can direct. I'm happy to brainstorm. So definitely this is an area that in my opinion, Luis, that will require a space in the sector that we don't have. How many
Exactly.
sessions in the Congress are related to that? How many exactly financial directors? I mean, this should be something for financial director, right?
I think so.
They are quite of an animal that on their own, and this is also crazy, if I think about it. So we raise the money, and then who is managing is completely something else that we have nothing to do with it, right? So
Hmm.
the finance director is like a kingdom of his own, like and it shouldn't be, right? It should be much more integrated.
Yeah, and I think you're the way you're setting up these deals, these arrangements does help with that. It aligns incentives. So we're getting the financing now, but the fundraising has to work in the next few years. So I think that could also have that effect of connecting the silos. But hopefully this turns into kind of part of the menu. I don't imagine lots of financial directors thinking of these options when they're looking to build their budget for the next 5 to 10 years. So hopefully this has put some ideas in people's minds.
Yeah. I hope so.
Well, super grateful as always, Francesco. Thank you for sharing the results of your greatest work. We'll keep following you. Please do share your continued successes.
Great, and happy to follow up if anybody is interested, and I'll happy to also provide some link to material and things that people want to read more. Definitely, that's a lot going on.
Okay. Thank you, Francesco.
Wonderful. Thank you so much.
Take care. Have a great one.
Bye.